So I'd like to thank Mridul for the invitation and to congratulate IIM Kozhikode for setting up this new Center for Research on Banking and Finance. I think there is it fills a real need because in India the analyst landscape has come to be dominated by those associated with financial institutions. And while that is very good, that there are so many analysts, it really contributes to the richness of the discussion. But in financial institutions, the main concern seems to be forecasting. And while I think more academic or at a distant analysts focus more on explaining why. And that explaining why is important both for market-based analysts to improve their analysis and for policymakers to improve policy. So I wish the institution all the best, and I'm happy to participate in the inaugural conference. I'll be talking about external shocks and the kind of risks we've been discussing in the previous session. And from the emerging market perspective, what I want to emphasize here is that there is a reversal of roles. Earlier, the kind of global shocks, we were talking about which will the next crisis be. Global shocks originated in emerging markets. Their financial sector blew up, the exchange rate crisis, something. But over the past 20 years, there is a role reversal here. The shocks have originated in the advanced, developed capital markets. And emerging markets have been at the receiving end and have had to respond to this. Policy, my view is, has an important role to play in moderating the impact of the shocks. But the unfortunate thing is that most of the advice is still caught in a time lag because it seems to come from the perspective that the emerging markets are the source of volatility and problems and they need to improve their shop, so to speak. And that misses important degrees of freedom, which I think our policy over the last two post-pandemic period has really benefited from. So I'll try to illustrate some of this. Starting with some research I've done with some students. I'll give you the details later of the references for those who are interested. But in this much time, we can't do very much. So these are rigorous sort of panel database for emerging markets, 8 to 10 emerging markets over more than a dozen years. And what the chief results you get from this is that there has been a change in cross-border flows from cross-border loans that dominated before the global financial crisis to what EDS, emerging debt securities. And that this EDS and their volatility is influenced more by global volatility, the VIX, rather than monetary policy. So here in a lot of discussion, we see focus on the Fed and what the Fed is doing, while it's global volatility that seems to affect these inflows and their effects on us more. Therefore, and also a very important result for us is that the spread, the EMBI spread, rises with domestic inflation. So domestic variables are important. Also, exchange rate volatility has a major role. And it falls with growth, with better macroeconomic stability. And therefore, another paper we have, the last line talks about this, looks at the importance, finds that just plain Taylor rule is not as efficient in welfare terms, or even augmented Taylor rule, which brings there is some problems. You don't have to raise interest rates in general. So it's a substitute for that and allows policy to achieve its outcomes to improve stability at less cost. Another set of papers I have with Kritika Banerjee is on the determinants of real misalignment for the exchange rate. And here we test a whole lot of domestic EM variables, fragility, etc., mercantilist motivations, as well as the quantitative easing, etc., high liquidity cross-border flows, which originate from emerging markets. And we find, with a lot of robustness tests, etc., that portfolio investment flows do cause a lot of the overvaluation, and that the spread risk premium is important for spread again, rather than interest rates or monetary policy. And some mercantilist variables as a motivation for exchange rate intervention were important for some countries, only Russia and China. So again, we see the dominance of cross-border flows, and risk premium has a larger effect than monetary policy. So this is just highlighting some of those results. Of course, this is just the key, which we have been discussing, a lot of control variables and so on, which are dropped in this table. But you see here that when VIX is high, the impact on EMBI spread is much higher. The second row shows that. And you show the large, significant impact of the exchange rate change on the risk spread. So since the global financial crisis, this causality from advanced economies to emerging markets, while and World Bank careful research over a large range of countries, as well as our own, which focused on 8 to 10 years, shows that for emerging markets, growth was much slower in the 2010s, this period after the global financial crisis. And this global volatility affected capital flows and financing conditions. There was overreaction in effects on flows, on all sorts of financial sector. There are all sorts of financial fragilities in advanced economies especially. But my own view to answer the question I asked is that the lender of last resort, they continued with quantitative tightening, but made a lot of liquidity available to a range of the financial sector wherever there was any trouble. The interest rate risk that affected a lot of banks in the US, not just SVB, really helped. Now, what can emerging markets do? So what we have been doing in the MPC or emerging markets in general is keeping the natural interest rate, the interest rate near equilibrium, and responding to domestic variables such as inflation and growth. And this in India required the spread with US rates to narrow, as the US Fed raised rates more steeply than we did. And we got a lot of worry from Indian analysts who tend to be very focused on the US and on maintaining spreads with the US. But our experience suggests that interest differentials do not really matter that much in the Indian context at present. I flag both these I flag, and I'll explain why. Now this shows the spread in repo and 10-year G-Secs over the US corresponding rates. And we see that it's falling through. The spreads were at the narrowest in the latest period after the US rate rise finished. And our rate rise was just half of that. But we began from a higher level, So, but in the same period, you see those blue spikes, and the red spikes are debt. You see that we see that there was a very large rise in inflows in this period when the interest differential was the narrowest. So again, the focus on interest differentials by analysts in India seems the evidence suggests it is misplaced. So do we have independence from US interest rates? There's a basic text equation I do, and I'm very happy to see so many of my students here. And they'll have seen me discuss this equation in class, the UIP. The interest rate in India is linked to that in the US, plus expected depreciation and country risk premium. So, and this research we just reviewed in the first slide suggests that this risk premium and exchange rate change matters more than the US policy interest rate for volatility, foreign flows into India. And in India, we have more independence because this country risk premium is coming down. One reason is our carefully sequenced capital account convertibility. So the capital affected by interest, when I said in India and at present, the US and Japan is really affected by interest differential, UK, where there are absolutely no barriers and the share of debt flows is very large. So when India reaches that, we will also be sensitive, but not at present. The share of capital affected by UIP is small. It's less than 6% of the domestic market. That is one of the caps in existence at present. And as Indian macros become more stable, the risk premium is falling. Our interest differential is much lower, with the US much lower than they were historically. Growth is more stable, increasing size, economic diversity. And moreover, timely support, reversal, and reforms in the post-pandemic period actually reduced this interest rate spreads also. Financial stability improved. Banks were regarded as very vulnerable, but NPAs came down over this period. We saw stock markets become much more, I'm in the home of the stock, one of the major stock exchanges. So we saw volatility. Earlier, in any time of crisis, you'd see large outflows and markets would crash. This time, this was an opportunity for domestic players to come in, and that made the whole thing much more stable. And overall, an emphasis on corporate governance and transparency, disclosures. Again, some of the reforms Ananth was talking about, the kind of information they have at the individual PAN level, the margins and so on. All that made our markets very stable. Another thing that has increased our degrees of freedom or made us less vulnerable to these outflows is that in absolute terms, these outflows are very large, the first graph we saw. But as a ratio of GDP, they're actually falling. As our GDP rises, that means that the absorptive capacity is much higher now. Please tell me if I have 5 minutes left.
10 minutes or so.
Okay, great. So apart from keeping the interest rate near equilibrium, and equilibrium determined by domestic growth and inflation, the second policy focus is to keep the real exchange rate near equilibrium, because we have a current trade deficit, and the exchange rate must be competitive so that we can export enough to cover all our import requirements for oil, etc. And moreover, reducing the volatility of the exchange, nominal exchange rate now, is important, we saw, for reducing that interest risk premium and interest spreads. There are much research on this, which shows that the UIP premium charged to emerging markets is on average 3%, and it's an excess return to markets because actual depreciation is much less than this. Again, there's a policy brief that talks about this. And this UIP premium, emerging markets have to pay more for excess volatility, which unfortunately is due to advanced economy policy overreaction, QE, QT, etc., etc. And the textbook prescription is that under inflation targeting, you need the exchange rate to be flexible to absorb shocks. And the exchange rate will depreciate and then appreciate back towards equilibrium. In emerging markets, it does not happen like that. You'll have one-way movements. Yeah. So this policy, textbook policy, does not reduce spreads in emerging markets. And raising interest rates to defend the currency, which is sometimes advocated and was tried in 2013 in India, only raises risk premium. So what is required in emerging markets is to use multiple instruments to reduce volatility, risk, and spreads. there is work on resilience recently after all these crises, this particular period of, as I call, pluri-crisis or poly-shocks, is that central banks should target risk premiums to reduce interest rate spreads and risk in the financial sector, not only in emerging markets, advanced economies also. And unfortunately, this is exactly what India was doing in the foreign exchange market, the Reserve Bank was doing in the foreign exchange market, where our large foreign exchange reserves were used counter-cyclically for the first time. I remember in 22, we got so many queries, people were so worried. They're happy when reserves are rising, no matter how high they go. But even a little fall makes them really worried, and they think disaster, we're going to be, so after all, if you accumulate any buffer, it's meant to be used. It should go up and down. So, as I said, the fall in rupee volatility reduced Indian forward premium, really fell. The figures are here. But still, some volatility is good for markets, and it helps them in price discovery, because this intervention is only to prevent excess volatility, not to find the price or to fix the interest rate, exchange rate. But if there's overshooting and persistent overshooting, it can lead to deviation from this competitive equilibrium real exchange rate, which is required. And this excess volatility itself hurts exports and widens the current account deficit. But unfortunately, the IMF has labeled India in this period, Indian regime in this period, as a stabilized arrangement and not market determined or whatever. Now, this is absolutely not correct because, first of all, you can't make this kind of label based on a one-year period. This was a period of large inflows which would have strengthened it above the equilibrium level. And international institutions provide very little in terms of safety nets to emerging markets. And so this is that policy mindset. They assume there are problems in emerging markets. They must follow the most conservative policies, while the US Fed should follow whatever maximizes their growth. Emerging markets can't do that. So the advice is for the most conservative policy set, and it wants exchange rates to float. That means you just follow the US Fed. You don't think independently on your own policy. And we've had episodes in the past, although the exchange rate is market determined, 1 or 2 years in the past, also the volatility fell during periods of large inflows. One of these periods was after the GFC. So for a short period, if the volatility is relatively lower than it was historically, there's more intervention. That does not mean it's a stabilized or it's not a market-determined regime. So this shows two different bases, the real effective exchange rate and how the real effective exchange rate around 100 is a value that is near equilibrium and that is good for the trade. And we were at that level, and therefore intervention is required to keep it at that level. One of the policy successes in this period was because in the 2010s, when our exports really fell, there was real appreciation. So what are the consequences of policy choices? As I said, one of the reasons we had this degree of freedom, apart from improving size and diversity, was the choice of gradual capital account convertibility. For example, Indonesia, again in the 2010s, there was a huge push from international institutions saying that a lot of money wanted to come into emerging markets, that local currency bonds. You will not have the currency risk, you should allow these to come in, and Indonesia did that, and their share of foreign money in the bond market went up to 40%. India was at 4%. And they were really affected by the taper tantrum in terms of interest rate volatility. Similarly, today, while we were able to determine our own repo, they had to follow the US Fed much more in its tightening. So you lose degrees of freedom you have to keep those degrees of freedom and use them in order to be able to respond to domestic needs. So of course, I've said that policy was successful, but we must all recognize that there are huge risks that continue and you have to be really vigilant. Risks in India really suffers from a lot of volatility in oil, and even this is to do with some deregulation that created a lot of volatility in oil markets. the deregulation of the Global Future Commodity Market Act in the US in the 2000s. This graph will show you how volatility of oil prices really increased after that period. And again, this is something that emerging markets suffer, the lack of regulation or the kind of deregulation that is there in some advanced economies that are dominant for the world. Other risks for India include food prices, climate change, agriculture. We need to diversify our supply chains and do much more over there. Given that we have natural geographic diversity, we can take advantage of.
We are almost about to...
Then using buffers strategically, which we've done, building buffers and using them. So resilience requires that policy should be balanced, not textbook or extreme. Some flexibility is really required for India's own huge complexity and diversity. And it is possible to smooth external shocks and to differentiate macroeconomic policy if reforms and policy maintain degrees of freedom and use them. Thank you.
Thank you, ma'am. Next. Institute of Economic Growth and former RBI MPC member. His lecture is on debt flows and sovereign debt management.
Be here. So since I'm an academic, I think our job should be to produce new research and show it to you. So that's what I'm going to do. And but the motivation where I'm coming from is, the first motivation is that a lot of work on spillovers, on global spillovers, tries to understand how unconventional monetary policy is the source of these spillovers. And the question that this research asks is, what impacts does it have, of course, on the real economy, but what asset prices does it affect, right? So we know that unconventional monetary policy leads to a lot of base money expansion. Whether broad money increases as much is not clear, but it affects real estate markets, it affects the term premium, it affects the most important asset price in international finance, which is the exchange rate, the stock markets, and the risk-free rate, amongst others, right? So that's how one would think about the spillover impact from unconventional monetary policy when advanced economies are stuck at their zero lower bound and they have to enact expansionary fiscal policy and unconventional monetary policy. And the second question is, and the flavor that I've been getting all morning is that these spillovers are a cost, they're a source of fragility. We need to think about some arrangement of capital controls, appreciation of the currency, reserve management. Is how do EMEs get impacted? Now, one interpretation could be that if EMEs are at full employment and have current account surpluses, then that spillover, which leads to an appreciation of a currency, may actually be beneficial, because that appreciation leads to less export prospects and from the trade channel cools the economy down. So that's one way to think about the impact of spillovers, is the source of the spillover, what asset prices it is affecting, and how EMEs stand to either gain or lose, right? But in this discussion, what is missing is the spillovers, and I think this is kind of a post-COVID phenomenon, that will stem from attempts from national economies to reduce public debt. And how these spillovers are going to impact EMEs. And that's the flavor of what I want to talk about today. And within this sphere, I want to propose an alternative calculation to the average maturity of Indian public debt, using the market value of public debt as something else that market participants may be looking at when they assess the fiscal fragility of a country or fiscal headwinds of a country. And let me just say at the outset that I also think part of this exercise and part of my desire to want to speak here today is also driven by the fact that because we've had a long period of accommodative monetary policy, I think there's a complacency that is set in national economies to reduce public debt. And this is to kind of push this research, so to speak, in that sense. Okay, now, spillovers refer to, the international repercussions of domestic policy choices. And this stuff is known. We know sovereign debt markets are central to the macroeconomy. Spillovers can have significant wealth and risk effects. And international capital flows to sovereign debt markets have grown in importance. So India has recently been included in global bond indices and the JP Morgan global bond indices. By the way, there's an interesting thing there because there's a 10% cap on each country in that bond index, right? But it could be that if a particular country's bond increases in value, you would actually be in excess of that 10%. And then the way the global bond index works is that you would have to rebalance. And passive institutional mutual fund investors would then, who are replicating the index, would also rebalance. And that may actually lead to a source of capital or outflows or inflows into particular country bonds. So in this whole issue of identification, these are what are called informationless capital flows because they're essentially stemming from this rebalancing that needs to be done in the global bond index to make sure that every country is at that 10% cap. So that's the exogenous event that drives this analysis and trying to understand what happens. But what this research kind of shows, of course, India is now going to be part of it, and I think they'll slowly raise it by 1% starting in June, if I'm not wrong. What it shows for countries who are already part of these indices is that capital flows by passive mutual fund investors do actually spill over to the exchange rate market and leads to an appreciation. But as you all know, in government securities, most government securities in India are now at the flexible FAR, right? It's the free accessible route or the flexible accessible route. So 5, 7, and 10, 14 are FAR, and I think the 3-year may not be, but many of them are. Now, capital flows to EMEs, excluding China, have grown. And if you look at the orange kind of peach color, that's debt FPI. That bar has grown. And this is capital flows to EMEs excluding China because China kind of swamps everything. But both debt FDI and debt FPI, the yellow and peach bars are much larger. So this is something that, that we want to worry about. And the idea here is that, and this is just drawing from research, not that I've done, but which is Ashima has done and others have done, that growth differentials and domestic term premium are, so when you're thinking about push and pull factors, are the predominant pull factors driving capital flows to India. And global risk aversion appears to be the major push factor. And this is just a similar graph looking at capital flows to EMEs. But the point I want to emphasize here is India is this kind of turquoise blue thing here. On top is that the share of India in EME capital flows is still about 13% of all EME capital flows. So it's not large, but it is large, but it's also not large. And even here, I think in India we've always had this hierarchy of in terms of capital account liberalization is thinking about a hierarchy where we've always deemed FDI to be better than FPI and we've deemed equity to be better than debt. And one of the things I want to propose is that maybe that hierarchy is possibly not that valid anymore today. Okay? Okay, and then here are a set of other graphs. I'm sorry, this is not very clear, but again, it looks at India versus regional peers, and looking at capital inflows and volatility. Our average quantity inflows for FDI volatility is not very large. For portfolio debt, it doesn't tend to be that large. For portfolio equity, it tends to be larger when you compare to other Asia EMEs. And that red little diamond is the India diamond. And then if you look at non-resident capital flow volatility, again, FDI is the lowest, portfolio is slightly higher. And then, of course, if you look at quarterly average capital flows, percentage of quarterly GDP, debt flows are fairly small. So portfolio equity and FDI is about 2.5% of GDP, and debt flows are about 0.5% of GDP. So they're much smaller, right? So one rule of thumb could be that the amount of reserves that you want to have are a quantum that covers these, right? That's a very risk-averse approach to looking at it, but that could be one approach that you quantify these different flows and you say you want to cover it by having these many reserves. And then in our, again, this is not work I've done, I've borrowed it from Goyal and Novikova. I have a nice paper here showing that India's FDI restrictiveness has begun to come closer to the OECD average and doing slightly better than the EMDE averages as well over time. So it's slowly beginning to. And then here's an important point is that the upper limits on foreign portfolio investments in different types of bonds have been increasing over time, but there's unused capacity in these buckets, and those have slowly been declining over time. And this is the thing about capital controls, they don't bind until you actually meet the caps. So the argument that it's a proxy tax doesn't really hold because you're not really filling the cap, right? And I'll talk later on about the efficacy of short-term capital controls versus long-term capital controls. The view in capital controls is that because you have pecuniary externalities from financial flows, capital controls act like a Pigouvian tax to prevent these externalities. So you have unutilized capacities in different buckets, and these buckets upper limits have been increasing over time. Okay, now, so that was the first motivation. First motivation is to basically say, look, we tend to think of global spillovers as being driven by unconventional monetary policy. I want to propose, and this is also work in the academic literature, that we are now going to begin to see global spillovers stemming from fiscal simply. So you have a country that, let's say prior to COVID, decides to expand fiscal policies. Its government, you all know that should be a boost to GDP, and that should raise output, and output caps begin to go up. And as inflation begins to go up, central banks respond by raising the nominal interest rate. But here's what is key here. The real interest rate doesn't rise. We typically argue that, if nominal interest rates rise and prices are sticky, then real interest rates rise. Because that fiscal expansion, the original fiscal expansion, comes in announced with a future consolidation path, market participants anticipate that this fiscal spending is going to be reversed in the future. So the immediate impact effect of this rise in government spending is to reduce these long-term real interest rates. And the reduction in these long-term real interest rates, despite an increase in the short-term nominal rate, induces consumption and investment and absorption to increase. So what you get is a bigger boost in output because the initial impetus was a rise in G, but now you have this increase in C and you have a higher increase in I, and so you get this boost in output. So now income has gone up more than the initial fiscal stimulus. And then because income has gone up, import demand from other countries go up, so that gives a boost to other countries' exports, that forces them to raise interest rates, that leads to inflation. But the key thing here is that because real interest rates fall, you see a depreciation in the currency of the country that has enacted the stimulus. And because you see a depreciation, a real depreciation in the country who's enacted the stimulus, you see an appreciation of the EME, who's at the other end of the thing. So this is the spillover and the mechanism through which we're possibly going to see an appreciation as countries begin to fiscally consolidate. This is possibly one way through which it'll happen, and it'll happen through other ways too, but this is one way through which an appreciation happens, is because these other effects kick in due to the endogenous dynamics of global interest rates. Now, I just want to mention that since the adoption of flexible inflation targeting, the volatility across a bunch of components in India has gone down. For one, the institutional framework is much more clear for market participants. People understand what the central bank is doing. There's an MPC, there are minutes, MPC members communicate their views, so market participants understand it. And so credibility premia rise. And one way of actually seeing that is in the 2018 interest rate cycle, when the MPC was raising interest rates, and I think the 10-year GSEC at that point went up to about 8.5%. Now in this cycle, you see the 10-year GSEC going to about 6.5%. So for a similar magnitude rise in the policy rate, you see a lower increase in the 10-year GSEC, reflecting the fact that there's a credibility premium that market participants attach to the fact that there's flexible inflation targeting. And while the RBI curbs flexibility in the exchange rate, and of course the motivation for central banks to intervene in exchange rate markets is to reduce volatility, excess volatility, it has not fixed the exchange rate. So it does allow the interest rate differential to therefore predict the behavior of where the exchange rate is going to go. Okay? That's important to appreciate. Now, going back to the public debt story and my argument that we need to worry about the size of public debt and what the spillovers are going to be when countries begin to consolidate. Now, this is India's debt to GDP ratio, and this is based on recent work. It's a carefully kind of crafted series, but we see this rise starting around COVID, and this is aggregate debt. This is general debt. So this is central debt plus state debt, and it goes from about whatever 60-70% of GDP to about 85-88%, and now there's a Fiscal Finance Commission announced a glide path and so on. And then most of the financing of the fiscal deficit is from market borrowings, and this is kind of a time trend of it. But here's how I want you to think about the average maturity of debt. The government budget constraint, and I'm sorry to throw an equation at you, but I have to. The government budget constraint is this equation on the top. And it's met by three different things the government can do. The ST plus J is the primary surplus, right? It's just G minus T. So if the government basically, let's say, cuts government spending, right? So government spending goes down. What will happen to the primary surplus? The primary surplus will go up, right? Right-hand side goes up, and it can be met by, or if the government spends more, then the primary surplus will go down. Let's take that example. Suppose the government spends more, primary surplus goes down. It can do two adjustments to the left-hand side for the government budget constraint to meet. It can basically inflate away that action, right, by raising P, or it can change Q times B, which is the maturity structure of debt. It can issue more dated securities, it can issue dated securities in some buckets, but as it begins to increase the supply of that paper, that's going to affect the price of that paper. So it can alter the maturity structure of debt without inflating away the impact of the reduction in primary surplus on public debt by changing the maturity structure of debt. But that's why it is important to therefore capture the average maturity of debt. And this just shows that over time you see issuance in higher buckets. So I think now there's a 50-year Government of India bond. By the way, in all these things, a form of subtle capital control is that they're withholding taxes. So, and that's a hassle for FPIs, and they get it back, I think, when they file returns. But these are all parts of it. But you see, moving the red lines, the red dotted lines, as it moves up along the vertical axis, is essentially showing that there's been far more issuance of dated securities, and this is based on granular data that we've calculated from using RBI's sources. So to highlight this approach, this is the approach that calculates the average maturity of debt. So we have all central government securities issued from 2000. We break these into zero coupon bonds. we have the principal matrix, we have the coupon matrix, so we have total payments. Total payments just means this, that in every period, we know that some security is either the principal is being paid back and the final coupon period, or if that principal is going to be paid back, paid out 5 years from now, there may be coupons being paid now. But in every period, there's some obligation by the government through coupon payments or principals, so we calculate that. So you get a coupon matrix, you grab the yield to maturities, right, from the yield curve, so you're able to construct prices, and then from those prices, you're able to calculate the market value of debt. So the Holland-Sargent approach is important because it looks at the market value of debt. When we calculate average maturity using the status papers or the status reports of the Ministry of Finance, we're just looking at the face value of debt. We look at a particular bucket divided by the total face value, multiply it by the year it is due, and then we add the face value over total, multiplied by, let's say, 2-year issuance, and so on. But in the Holland-Sargent approach, you're capturing all obligations due in one period, all principals and all coupon payments divided by the market value. Now, if the central bank is running accommodative monetary policy, which means the risk-free rate is low, then the market value of debt will be high. And if the market value of debt is high, then obligations relative to the market value of debt will be low. But anybody who owns a government bond, which has a rising market value, may want to sell it to make a capital gain. And that raises the rollover risk. And therefore, that gets reflected into declining average maturity of public debt in a way that face value calculations don't incorporate. Okay? So we've done this exercise. So I'll just show you what we get for the average maturity of debt. But in the decomposition, what we get is that the nominal returns on marketable debt, so in the top thing, 2020 to 2022.
Professor Ghate, we are almost about time.
I have 2 minutes, maybe?
Sure, go ahead.
Okay, market value in 2000 was, central government debt was about 19.7% of GDP. And in 2022, it went to, this is just central securities, not state securities, it was 50% of GDP. So there's a roughly 30% change in the market value of debt. Of this 30% change, the nominal return on marketable debt was 55% of this total change. It was the biggest driver of the change in the market value of debt, much more than, and then if you compare this broken down to the 1 to 2 year bucket, the 2 to 10 year bucket, the 2 to 10 year bucket, of course, is the most liquid, so you see the most issuance here. It's about 30% of this, of this 30% total change. Okay, so the Holland-Sargent approach allows you to quantify this breakup between and breakup in the change of debt. And this is the average maturity that we get here for India. It hovers between about 6 years, whereas the status reports say that that graph I showed you where there was higher issuance would calculate it to be about 14 to 15 years. It's a very different number because they're looking at face value and we're looking at market value. And so you would say, United States, country with, a large public debt, but, they issue the dollar. They probably presumably have lower rollover risk, so they can, afford to have a lower average maturity. But we overstate our maturity by just looking at the face value of debt. Okay, since I've run out of time, let me spend the last minute basically on a few implications for capital controls. Now, this is where we need more work, and this is for the students out there, is that we need more work on figuring out what the optimal level of reserves are. And what's the relative efficacy of ex post controls and ex ante controls, right? And we need also to determine the optimal level of reserves depending on the risks of sudden stops. We need to tie in that discussion on how to think about sudden stops. That's one set of observations. And then I think what we really need, this is what's interesting, is that if you look at the Chin-Ito index, it doesn't really budge much as far as my kind of preliminary looking of it is. It doesn't really budge much, even though India has successfully dismantled all kinds of capital controls. But I think we need more research here on thinking about capital controls beyond the Chin-Ito index. maybe related to the amplitude of credit cycles, maybe looking at credit cycles and subsets of capital flows like FPI cycles, FDI cycles, and FPI debt cycles. We need more work on that. And then this goes back to the point about, the Tinbergen principle. So if you have multiple targets, you need multiple instruments. There's a little bit, so with flexible inflation targeting, the idea is that, the flexibility of the exchange rate gives you an additional tool to absorb shocks. But there's now some work which is now beginning to also help shape thinking about whether central banks should also, in addition to target inflation, continue to sterilize the exchange rate and may begin to reap higher welfare gains because of doing that. So they can, actually target the exchange rate as well, in addition to targeting inflation. And just finally to end, this is our calculation of the average maturity of debt compared to what the status reports pulls out, and it's substantially lower. So I'll just end by saying that we need to think about spillovers, the sources of spillovers, the asset prices they affect, and one of the under-thought, under-researched aspects of spillovers are the ones that we are going to now the ones that we're going to see in the future, which is coming from debt consolidation. Those spillovers are going to have effects on all kinds of EME asset prices, and we therefore need a whole set of fiscal metrics to better understand how debt outflows may or may not happen. Thank you.
So we are overshooting very quickly the discussion.
Should we?
A few. No, please go ahead.
Okay. We are almost about to kind of. But unfortunately, despite all that, the rating upgrades did not happen, right? So in fact, one of the discussion in the morning session was, how do we make that case, right? So, how does academics play a role here? And what are the various ways that we can make that case academically, right? And in fact, some of the work that has been done on implied ratings, is there a direction that we should take? That's one of the areas that, if you can comment. The other one, of course, we also kind of talked about it, the bond inclusion that we all are expecting. And you've talked about the rebalancing effect, right? And what would be the potential rebalancing effect probably on corporate yields going forward? Is it something that, that we have to also worry about? And, what would be the predictions from your models on the maturity profiles, right? On as a result of this particular inclusion, like would it be something which is will lengthen the profile, or would it make a difference in the other direction? And one of the interesting aspects that Professor Ghate's work also brings in is that there's a difference between face value and market value, right? And we have seen that makes a difference in terms of the actual maturity that you see that the market participants are actually telling us versus what is being claimed. What would be the overall, for example, lesson from this? Like, how does the overall market debt to GDP ratio fare vis-a-vis the face value that we all kind of talk about, right? So are the profiles going to be different? If so, what could be the various factors behind the difference in profiles? Maybe the factorization that you talked about could be something that we can use on. So if you can respond to any one of them, or we can open up the floors.
We can quickly respond. You want to go first, Ashima?
Okay, I'll just make a couple of points. First, I think the impact of bond index inclusion, there's a lot of discussion on this. One of those graphs that I showed that we are much below in terms of GDP. And also that given even the medium-term framework, there's some limits currently. We are much below those. So there's a lot of scope for and given that this is going to be graduated at about 30 billion is expected, I don't think it's going to create any volatility, and it will be absorbed. It might bring down yields and lower the cost of government borrowing, etc., which should be useful. The second thing I'll comment on is the rating agencies and what. So here, when I was saying that there's that policy lag, we see this in international institutions. I think all of us, we take a long time to perceive that things have changed. We are trapped in the past. So to help that realization and that shift, recently kind of discussion of India's fisc, for example, the IMF told us that our debt GDP ratio is going to rise beyond 100. Now this is happening in the US, but in India we are seeing deficit ratios come down. And I have this, and actually because we have much higher growth, you should see the ratios come down. In fact, I had a paper on this, I call it a possible escape route, because it is true our ratios are much higher than East Asia and so on, but it's partly because you've never been counter-cyclical, and this government seems to be conservative. I have this very interesting graph, where you look at the deficit ratios after the GFC, it's like a plateau, it continues. While after the pandemic, there's a sharp V shape, partly because GDP was negative then positive. But we are seeing fiscal consolidation immediately. So the big mistake India made in the 2010s was high growth, so spend more. So it was pro-cyclical spending instead of building up buffers. But I think we are understanding the utility of buffers, so creating fiscal buffers also. And all this should gradually help people understand that the reality is different from their perceptions and things are changing on the ground. Thank you.
So on your question about inclusion, so the index is about $230 billion, something of that magnitude. India's weight is about 10% of that. So it's about $25–30 billion of additional flows. And I think that probably be limited appreciation from that, just from that quantum. But what we're putting on the table is another way to assess fiscal risks that for countries that run fiscal deficits, they want to extend the maturity of their debt because they worry about rollover risk. But what we're saying is that that may not necessarily be true, because once you take the market value, you actually do have quite a lot of rollover risk. Average maturities actually fall. So the fiscal risks do still come back onto the table, and they are something to worry about.
Do we have time for audience questions?
You can take one question.
I am Navdeep, a student from IGIDR. I have a question for Ashima Goyal ma'am on things which I don't understand in the MPC statement. So first of all, if the interest rate differential doesn't matter much, as you have said, then why is RBI hesitant on even changing the stance of MPC? And why the RBI has complicated the stance language in the second Monetary Policy Committee by introducing withdrawal of accommodation? And the second question is that since the core inflation is coming down, then how do RBI justify the projections, growth projections which they have made?
Yeah, so this is, sort of out of this session. I don't know if I'm allowed to answer. Anyway, I'm not in a quiet period, so I can... so I don't see why you think that we are following the US in whatever we are doing, or whatever we are doing is really related to what is required domestically. Now, the stance... it has to be understood as coming from the pandemic time, when there was for the first time, an expansion of the balance sheet, a large amount of liquidity injected, and overall stimulus, and therefore withdrawal. But currently, since we are not at the target, you still want to focus on disinflation and reaching the inflation target. So you continue with that withdrawal term. But now it has to be interpreted strictly in terms of the rate, the real rate or the policy rate still being disinflationary. Yeah? And core inflation, since our target is headline, core inflation is lower than the target, but it is headline which affects people's expectations, wages, and therefore other enters various contracts. So we want to see that headline comes down to the target. Although core is more what is affected by excess demand that the RBI can control, but also inflationary expectations. There's a very important expectations channel, and this affects headline also. And research now suggests in current situations that it is core which is more steady, and that affects expectations, and headline comes down to core. So we should see this happen soon. Thank you. I thought this was a goal. No. So no goods and values.
Yeah.